Imagine for a second that you just delivered the absolute best presentation of your entire career. Like you hit every single metric your company asked for. Your boss is literally giving you a standing ovation in the boardroom, and then human resources calls you in and hands you a 12% pay cut.
Oh, man. Yeah, that is a total gut punch.
Right. It is just this feeling of utter baffling confusion. And honestly, that is exactly what we are plunging into today. Welcome to this special time in Market Deep Dive. Just a quick reminder before we really jump in, though, this deep dive is strictly for entertainment purposes. And, you should always seek professional advice before making any investment decisions.
Yeah, always a necessary ground rule. I mean, especially given the wild market volatility we are unpacking in this session.
Exactly. So today, our focus is entirely on the audio streaming giant Spotify, ticker symbol SPOT. And specifically, we're looking at their explosive Q1 2026 earnings update.
And we have a massive stack of sources on the table for this one.
We really do. We've got the official company presentations, the actual Q1 earnings call transcripts, financial analysis from Motley Fool, some market reporting from Benzinga, and we're even tapping into the raw retail investor sentiment over on Reddit. So we have all angles covered.
Which is good, because our mission today is to unravel a massive paradox at the center of Spotify's latest print. Because by all accounts, I mean, on paper, this was a flawless quarter.
Literally flawless. And yet, the stock absolutely tanked right after the news dropped.
Yeah.
It closed at $434.20, down over 12%.
It's just one of those moments that makes, casual observers throw their hands up and declare the stock market is just completely broken.
Right.
But when we synthesize these sources, a very clear, albeit highly complex narrative emerges regarding what investors actually value right now.
Yeah. So we are going to figure out exactly why the market reacted this way. And I guess more importantly, what it means for the company's future. So let's start with the setup, because we really need to understand just how good these numbers looked in the rearview mirror to appreciate how weird this massive stock drop actually is.
It's the report card analogy.
Exactly. If you bring home a report card with straight A's, you expect a high five, right? You don't expect to be grounded for the weekend. And looking at these user numbers, I mean, it looks like a straight A report card. The sources say monthly active users hit 761 million.
Yeah. And to put that 761 million into perspective, that is roughly 1 in 10 people on planet Earth.
Wow.
Yeah, 1 in 10 people actively opening the Spotify app every single month. It represents a 12% increase year over year. They added 10 million active users just in this first quarter alone.
Which completely outpaced their own internal guidance, right?
Exactly. Management only promised the market 8 million, so they over-delivered there. And importantly, it is not just the free tier driving this. The premium subscriber count, the people actually entering a credit card, that reached 293 million.
And it seems like that user growth actually translated to the bottom line, too. I was looking through the earnings report, and the profit numbers just look massive. But I'll let you handle the decimals on this one. How much did they actually make compared to what Wall Street wanted?
Right. So earnings per share came in at $4.04. Wall Street analysts had only penciled in $3.72. So it's a massive beat. Furthermore, they generated a record 824 million euros in free cash flow.
Okay, wait, let's pause on free cash flow for a second, because financial jargon can get super dense.
Sure.
Free cash flow isn't just some accounting term, right? It's the actual liquid cash generated by the business after backing out all the capital expenditures to keep the lights on.
That is the perfect way to look at it, yeah. Because net income can be manipulated with accounting magic.
Like depreciation and all that.
Yeah, exactly. Depreciation, amortization, things like that. Free cash flow is the hard cash actually hitting the bank account. Generating 824 million euros in a single quarter gives them a tremendous war chest. They ended the quarter with 8.8 billion euros in cash and short-term investments, and effectively zero debt outside of standard office lease liabilities.
Okay, let's unpack this, because everything you just laid out sounds like a company firing on all cylinders. But there's one specific metric in this report that really caught my eye. The sources keep calling it the holy grail metric for Spotify.
Ah, the gross margin.
Yes. Their gross margin hit 33.0%.
Breaking that threshold is a monumental psychological victory for the company. It represents an expansion of 133 basis points from the year before.
Wait, 133 basis points. For those of us who don't work on Wall Street, that just means 1.33%.
Yep, exactly.
So why is that tiny percentage expansion such a massive deal? It sounds so small.
Well, because of the historical bear case against Spotify. For years, literally since the company went public, critics have argued that Spotify isn't a real tech company. The argument was that they were essentially just a very pretty low-margin middleman for the major record labels like Universal and Sony.
Oh, because every single time I play a song, Spotify has to pay a massive royalty fee to the label.
Right. So the skeptics said, look, it doesn't matter how big Spotify gets. If they make $1, 70 cents goes straight out the door to the music labels. They will never achieve true software profit margins. The fear was that they were trapped in a fundamentally flawed business model.
So hitting that 33%.
Hitting 33.0% proves that their model actually scales. It proves they can grow revenue faster than their music costs. They are finally achieving the operating leverage investors have been demanding for a decade. In fact, their operating income reached a record 715 million euros.
Okay, so we have a company that beat on users, beat on earnings, generated record cash, and finally proved the haters wrong by hitting their holy grail profit margin. The structural business is sound. So how could a company hit this long-awaited target and still see its stock crater over 12% in a single day?
The answer lies in the difference between the rearview mirror and the windshield.
Okay, I like that.
The stock market fundamentally is a discounting mechanism. It is rarely reacting to what you just did in the last 90 days. It is reacting to what you are going to do next year. So to answer your question, we have to look through the windshield at Q2 and beyond. And when you do that, well, you start to see the cracks.
Okay, let's talk about those cracks. Because diving into these earnings call transcripts and the market analysis, the first red flag that pops up is on the revenue side. They reported total revenue of roughly $5.3 billion. But the sources show analysts were expecting slightly more than that.
Right. A slight miss, but a miss nonetheless. And much more concerning to Wall Street was the Q2 guidance.
What did that look like?
Spotify management came out and forecast roughly $5.545 billion for the next quarter, but the street wanted $5.650 billion.
So they are telling the market, hey, we aren't going to grow quite as fast next quarter as you thought we would.
Exactly.
Can you explain the dynamic of forward pricing to the listener? Because why does a slight miss in a future estimate completely overshadow the reality of, like, record cash in the bank today?
Think of forward pricing like paying $500 up front for a highly anticipated 10-course tasting menu.
Okay.
You are paying that massive premium because you expect every single course to be exponentially better than the last. That expectation is already baked into the price you paid at the door. If the chef comes out after the third course and says, hey, just a heads up, the dessert might only be average, you suddenly feel like you overpaid for the entire evening, even if the appetizers were incredible.
Oh, because you didn't pay for what already happened. You paid for the promise of the whole experience.
Exactly that. For a growth stock like Spotify, trading at its current valuations, the market expects exponential acceleration. When management signals that the next leg of the journey might be a little slower, the market immediately recalculates the value of the entire company downward.
And as one of the retail investors on Reddit perfectly summarized it, the market is no longer rewarding Spotify for just being better than last year.
Yeah, that's incredibly accurate.
And if you look closely at the engine driving that growth, not all the parts are working perfectly. Let's look at the ad-supported tier. I noticed that premium revenue, the people paying monthly, that grew really well, but the ad-supported revenue actually declined 5% year over year globally. What is going on there?
It is a fascinating divergence, really. If you adjust for foreign exchange rates, it technically grew about 3%, but that is still incredibly anemic compared to the premium side. The sources note that automated sales channels now account for over 30% of this ad revenue.
Automated sales channels, meaning programmatic advertising.
Yes. Instead of a human salesperson calling up a brand to sell a podcast ad, it is handled by an automated digital option in milliseconds. The problem is, if the broader advertising market is soft and brands are pulling back their budgets, those automated bids drop in value.
Right.
So Spotify has hundreds of millions of users on the free tier, generating billions of impressions. But an oversupply of impressions in a weak ad market lowers the price they can charge per ad. They simply aren't monetizing user attention as effectively as investors hoped.
Okay, that makes sense. And then there's the noise in the profit numbers.
Yes.
This part just blew my mind. So they reported that record operating income of 715 million euros, right? But the fine print in the financial statements reveals that a chunk of that profit wasn't from selling music subscriptions or podcast ads at all. It was a 49 million euro favorability in something called social charges. What even is a social charge, and why is it artificially boosting their profits?
Yeah, it is a very specific quirk of European tax law. So, a significant portion of Spotify's compensation to its employees is in the form of equity, stock options, and restricted stock units.
Pretty standard for tech.
Right. But in Sweden, where Spotify is headquartered, the company has to pay a social payroll tax based on the fluctuating value of that employee equity.
Wait, meaning if the Spotify stock price goes up, the company's tax bill goes up.
Which is super counterintuitive, but yes.
That's wild.
Now, in this specific quarter, because the share price actually experienced a drop during the measurement period, their anticipated tax bill plummeted by 49 million euros. That saved money flowed straight down to the operating income line.
Oh, wow. So it's a non-operational benefit.
Exactly. It makes the underlying business look slightly more profitable than it actually is on a structural level.
So Wall Street looks at the guidance miss, the weak advertising growth, and the fact that the profit was slightly padded by a Swedish tax quirk, and they decide to sell off the stock.
That's the short version, yeah.
But management isn't just sitting still. I mean, the market is demanding steeper growth and wider margins. So we need to look at exactly how Spotify's leadership plans to deliver that without burning through all their cash. And according to the Benzinga report and the earnings call, the answer lies in a massive efficiency play powered by artificial intelligence.
This is perhaps the most transformative shift happening inside the company right now, because for the last decade, the standard Silicon Valley tech playbook was, if you want to launch a new product or feature, you hire 200 new software engineers. That era is over.
Yeah, co-CEO Alex Nordstrom specifically highlighted this on the call. Last quarter, they actually reduced their headcount by 65 employees. Their total workforce globally sits at 7,258 people. Yet they're launching massive new products at a faster rate than ever. They claim AI is literally doubling employee productivity.
They are essentially substituting human capital for compute capital. Instead of increasing their payroll with new hires, they are pouring money into cloud and AI infrastructure. The goal is feature velocity. They want to prototype, test, and ship new tools to users at a fraction of the historical cost.
Okay, here's where it gets really interesting, because I have to push back on this strategy a little bit.
Sure.
If they are swapping payroll expenses for massive AI and cloud compute expenses, are they actually saving money in the long run? I mean, running massive AI server farms isn't exactly cheap. Are we just taking the employee payroll off the balance sheet and replacing it with a gargantuan Amazon Web Services bill?
That is the multi-billion-dollar question the entire tech industry is facing right now.
Yeah.
Management insists this increases their operating leverage because compute costs scale differently than human salaries. Humans require health insurance, 401k matches, office space, severance packages.
Right.
Servers just require electricity and maintenance. But you are entirely correct that AI compute is expensive. And as user usage scales, those server costs will scale alongside them. So the market will be watching those gross margins like a hawk over the next year to see if the AI efficiency narrative actually holds up.
And we should look at what they are actually using that compute for, too. The earnings call highlighted the AI DJ, which is approaching 94 million users. And they just rolled out a new feature called Song DNA, offering deeper insights into the stories behind the music, which grabbed 52 million users globally in just 4 weeks. Plus, they aren't just doing music anymore. They rolled out a Peloton fitness hub because they realized 70% of premium users work out monthly. And they expanded their audiobook charts in the US and UK.
It is a very deliberate strategy of deepening daily engagement. They want to become the single, indispensable audio layer for your entire life. Music while you work, Peloton classes while you run, audiobooks while you commute, and an AI DJ to curate it all seamlessly.
Which leads to my second pushback. Are these shiny new AI features actually driving new people to pull out their credit cards and subscribe? Or are they just expensive toys keeping the current 293 million users entertained?
The data suggests it is much more about retention than initial acquisition. In the subscription business, churn is the ultimate enemy. If you cancel your Spotify Premium, they lose that recurring revenue forever.
Yeah?
By deeply integrating AI personalization, where the app learns exactly what you want to hear, when you want to hear it, and even guides your workouts, the switching costs become incredibly high.
The switching costs. Because if I leave Spotify today, I lose my AI DJ who has spent years learning my taste perfectly.
That is the mechanism. If you move to a new platform, you have to manually train its algorithm from scratch. It is a very subtle but highly effective form of consumer lock-in.
Which is a perfect segue into the final and perhaps most critical part of our deep dive, the bear case. My question about user retention leads directly into Spotify's biggest existential threat. It's the competition. And it's severely limiting how much value Spotify can actually extract from this massive user base they've built.
And we really see this fear articulated clearly when we analyze the retail investor sentiment. The Reddit sources zero in on a massive looming threat, which is YouTube Premium.
Yeah, YouTube is a monster. According to
Yeah.
the sources, YouTube Premium now sits at 125 million subscribers. And here's the kicker. If you pay for YouTube Premium simply to get rid of the annoying ads on regular YouTube vlog videos, you get the YouTube Music streaming app included at absolutely no extra cost.
Exactly. This highlights the immense danger of competing against a corporate bundle. Spotify is a pure-play audio platform. They sell audio, and they have to make a profit on that audio. Alphabet, which owns YouTube, uses audio as a sweetener to sell video subscriptions. Alphabet doesn't need their music app to be wildly profitable on its own. They just need it to add enough value to the YouTube bundle to prevent you from canceling.
And that creates a terrifying pricing squeeze for Spotify. Let's look at their premium ARPU, average revenue per user. ARPU is basically just a fancy metric for exactly how many dollars Spotify can squeeze out of your personal wallet every month without making you cancel. Right now, it is sitting at roughly 4.76 euros.
Which isn't huge.
Right. It's basically flat year over year on a reported basis, though up about 5.7% if you strip out the currency fluctuations. But they are stuck between a rock and a hard place here.
Wall Street desperately wants to see that ARPU climb. They want Spotify to flex its pricing power and charge consumers more money for the service. But if Spotify pushes subscription prices too high, they run headfirst into the wall of subscription fatigue.
So what does this all mean? Think about your own monthly subscriptions right now. Imagine you are already paying for Netflix, Amazon Prime, your internet bill, and maybe YouTube Premium so you don't have to watch pre-roll ads. If Spotify raised its price by another $3 tomorrow, would you stay?
Or would you look at your phone, see the YouTube Music app sitting right there for free as part of your bundle, and just hit cancel on Spotify?
Exactly. That scenario is what keeps Spotify executives awake at night. One of the Reddit sources highlighted a very blunt critique of this dynamic. The investor asked, is a pure-play audio app with a hard ceiling on its pricing power because of bundled competition truly worth a $90 billion valuation? Or, to use their exact words, will Spotify become the AOL of music streaming?
Wow. The AOL of music streaming.
Yeah.
That is a brutal comparison.
It is, but we need to unpack why it's so terrifying. Because for those who don't remember, AOL was the absolute king of the internet dial-up era. They were the portal everyone used to access the web. But when broadband came along, internet access became a cheap, commoditized utility. AOL couldn't pivot their core business model fast enough and eventually got swallowed by the competition. The implication here is that standalone music streaming might just be a feature of a broader ecosystem, not a standalone, wildly profitable business in the long run.
It is a highly valid concern. I mean, Spotify clearly has the first mover advantage, superior brand love, and arguably the much better user interface. But as we've seen in tech history, brand love doesn't always translate to limitless pricing power when a quote-unquote good enough alternative is literally sitting there for free for tens of millions of people.
All right, let's distill all of this down for our listeners. We started this deep dive trying to solve a paradox. Why did a company post incredible straight-A numbers and watch its stock plummet? And the answer is a fascinating study of market psychology versus business reality. On a purely operational level, Spotify is arguably running better than it ever has in its 20-year history. They broke through the 33% gross margin barrier, proving to the skeptics that their platform economics actually work against the music labels. They're generating massive free cash flow, and they're successfully using AI to double employee productivity, shipping new features while actually shrinking their headcount.
So the underlying business structure is incredibly sound. But the stock market is not a scale weighing past performance. It's a game of future expectations.
Right.
Right now, the fear of soft advertising growth caused by automated bidding, a slight miss in forward revenue guidance, and the looming shadow of bundled competitors like YouTube is keeping the stock price heavily discounted. Investors demand that 10-course tasting menu of exponential acceleration. And Spotify is currently offering a very steady, very profitable, but linear climb.
It brings us right back to our employee with a flawless presentation who got a pay cut anyway. They did exactly what was asked. But the executives aren't looking at today's presentation. They are looking at next year's projections, and they are worried the growth isn't fast enough to justify the current salary.
It is the ultimate burden of being a highly valued tech stock. Absolute perfection today is just the baseline requirement. You have to promise a miracle for tomorrow.
Which leaves us with a final thought to ponder. As Spotify aggressively pushes outward to justify this massive $90 billion valuation, as they transform from a simple music player into a hub for ad-free Peloton workouts, audiobooks, and AI-generated radio hosts, are they at risk of losing their core identity? When you open the app to simply play your favorite album, and you have to navigate past a fitness instructor, a newly released thriller novel, and a robot DJ, does the relentless pursuit of infinite growth alienate the very music lovers who built the platform in the first place?
It is the classic innovator's dilemma. In trying to be absolutely everything to everyone just to please Wall Street, a company risks forgetting what made them indispensable to the consumer to begin with.
A great question to mull over next time you put your headphones on and fire up a playlist. Thanks for joining us on this deep dive.